Have you ever wondered what actually happens when you press buy on a stock? Where does your money go? Who gets it? Why does a stock price go up one minute and down the next? And if millions of people are buying and selling stocks every day, how does the entire system actually work? The stock market can seem complicated, but the basic idea is surprisingly simple. You're buying a small piece of a real business. But there's a lot happening behind that simple transaction. In this video, we're going to break down how the stock market actually works, step by step. We'll cover what stocks are, how companies get listed, how buying and selling happens, why prices move, what brokers do, how investors make money, and mistakes beginners should avoid. By the end, you'll understand the stock market without needing a finance degree. Let's start with the most important question. What exactly is a stock? Imagine you start a company called Future Tech. Your business becomes successful, but you need $10 million to expand. One option is borrowing the money from a bank. But there's another option. You can sell a portion of your company to investors. Let's say you divide the company into 1 million shares. If you own 100,000 shares, you own 10% of the company. Those shares represent ownership. That's essentially what a stock is. When you buy a share of a public company, a tiny ownership stake in that business. That's essentially and have the sensigi. You might think, that sounds great, but why would anyone sell part of their company? Because companies need capital. They can use that money to build factories, hire employees, develop products, acquire other businesses, or expand new markets. And investors buy shares because they hope the company becomes more valuable over time. This creates a relationship between businesses and investors. Businesses get access to capital. Investors get the opportunity to participate in the company's growth.
How does a company enter the stock market? But how does a private company become publicly traded? One common path is an IPO, or initial public offering. Before an IPO, a company is privately owned.
Its founders, employees, and early investors may own shares. When the company decides to go public, it works with financial institutions to offer shares to public investors.
Once the shares begin trading publicly, investors can buy and sell them through the stock market. But here's something important. When you buy a share on the stock exchange, your money doesn't go directly to the company. Instead, you're buying it from another investor, someone who is selling it.
Think of it like a marketplace. Imagine there are 100 people who own shares of a company. Some want to sell. Others want to buy. The stock market provides the system that allows these transactions to happen. That's where things get interesting. How does buying a stock actually work? Let's say you want to buy a stock at $100. You open your account and click buy. But it's not like your broker grabs a physical certificate from a giant warehouse. It's all digital, happening in milliseconds. Instead, your order is routed through the market's trading infrastructure. There are buyers and sellers constantly submitting orders. I'm willing to pay $99.95. A seller might say, I'll sell for $100. When compatible orders meet, a transaction can occur. This is one of the basic mechanisms behind stock prices. You'll often hear two terms. A seller might say, I'll sell for $100. When compatible orders meet, a transaction can occur. This is one of the basic mechanisms behind stock prices. You'll often hear two terms.
The bid is what buyers are willing to pay. The ask is what sellers will accept. The difference is called the spread.
When you place a market order, you're asking your broker to execute at the best available price.
With a limit order, you specify the maximum price you're willing to pay when buying, or the minimum price you're willing to accept when selling. This distinction is important for beginners.
Because the price you see on your screen isn't necessarily a guarantee that you'll get exactly that price. Markets move constantly. Now we reach one of the biggest questions. Why does a stock price change? Does a stock price change? The simple answer is supply and demand.
If more people want to buy a stock than sell it at the current price, buyers may need to offer higher prices to find sellers. That can push the price upward.
If more people want to sell than buy, prices may need to accept lower prices. But what causes people to suddenly want to buy or sell?
A huge number of things: company earnings, revenue growth, interest rates, economic conditions, new products, government policies, news, and sometimes simply emotion. Here's an important concept. Stock prices are based on expectations. Imagine a company reports profits. You'd expect the stock to go up, right? But instead, it actually falls because the future outlook was weak.
You might expect the stock to rise, but what if investors were already expecting those excellent results? The stock might barely move or even fall. Why?
Because the market is constantly comparing reality. That's why investing isn't simply about asking, is this a good company? You also need to consider, what does the market already expect? How do investors make money? There are several ways investors can potentially make money from stocks. The first is capital appreciation. Imagine you buy a stock for $50. Later, it rises to $80. If you sell at $80, your gain before taxes and other costs would be $30 per share. A gain isn't guaranteed. The stock could also fall from 50 to 30.
The second potential source of return is dividends. Some companies distribute part of their profits to shareholders. For example, a company might pay a dividend every quarter. If you own shares, you may receive those payments according to the company's dividend policy. But not every company pays dividends. Many growing companies prefer to reinvest their profits into the business. And that's why investors need to understand the difference between price growth and income.
What is a stock index? You've probably heard of the S&P 500, the Dow Jones, and the Nasdaq, but what are they? A stock index is a way of tracking a group of securities according to specific rules. The S&P 500, for example, tracks a broad group of large US companies. Instead of watching hundreds of individual stocks separately, investors can use an index as a broad measure of market performance. And this leads to one of the most popular investment products, index funds and ETFs. Instead of buying shares of just one company, an investor can buy a fund that holds a diversified group of investments.
For beginners, diversification is an important concept. If you put all your money into one company and something goes seriously wrong, your portfolio can suffer dramatically. This can reduce the risk.
But if your investments are spread across many companies and sectors, one company's problems may have a smaller impact on your overall portfolio. Of course, diversification doesn't eliminate risk. Markets can still fall.
What does a broker do? So where does your brokerage account fit into all of this? A brokerage firm provides the infrastructure that allows you to access financial markets.
You can use a brokerage account to place orders, view your holdings, research investments, and manage your portfolio. Modern investing has made this incredibly easy. You can potentially open an account from your phone and buy shares within minutes. But there's a danger here. Easy access can make investing feel like a game. You see a stock moving 10%, you see someone making thousands online. Suddenly, you're afraid of missing out, and you buy what you don't understand. This is the biggest danger for new investors. The stock market isn't a casino, but if you make decisions based on excitement, fear, or social media hype, your behavior can start to resemble gambling. Versus trading. It's also important to distinguish investing from trading. Investing generally focuses on owning assets for the longer term. An investor might research a company's business, financial health, and long-term prospects. Trading involves short-term buying and selling based on price movements. Neither label automatically makes a person successful. The time horizon and decision-making process can be very different. For someone just starting out, it's important to understand which approach they're actually following. Because buying a stock without a plan and then selling it a few days later because you're scared isn't really a long-term investment strategy. It's an emotional reaction. Now let's talk about one of the most powerful concepts in investing: compounding. Imagine you invest money and earn a return.
Instead of withdrawing that return, you leave it invested. Now your original money plus the accumulated returns can potentially generate additional returns. Over long periods, this can create a snowball effect.
The important word is time. You don't need to become rich overnight. In fact, long-term investing is often about consistency, patience, and allowing time to work in your favor. The earlier you understand this concept, the more useful it can become in your financial planning.
Some mistakes that should avoid. Before you start investing, here are 5 mistakes to money you can't afford to lose. Your emergency savings and essential expenses should not depend on short-term stock market performance.
Number 2, putting everything into one stock. Concentration can dramatically increase risk. Number 3, following social media hype. A stock trending online isn't automatically a good investment.
Number 4, trying to predict every market movement. Even professional investors can't consistently predict exactly what the market will do tomorrow. Number 5, panic selling. Markets can experience significant declines.
Making emotional decisions during a downturn can turn temporary losses into permanent ones. The key is to have a strategy before the market becomes emotional.
So, how does the stock market actually work? At its core, it's a marketplace where investors buy and sell ownership interests in businesses and other financial assets. Companies can access capital, investors can participate in potential growth and, in some cases, receive dividends. Prices move because buyers and sellers interact, and because investors constantly adjust their.
But successful investing isn't about finding a magical stock. It's about understanding what you're buying and thinking long-term. The stock market can look complicated from the outside, but once you understand the basic system, it becomes much easier to see what's actually happening. And remember, you don't have to predict the future to become a better investor. You need to understand the fundamentals, have a plan, and give your strategy enough time to work. Hit the like button and subscribe to Future IQ for more videos about personal finance. And if you want to learn more, watch our next video on how credit scores actually work in the United States. Thanks for watching, and I'll see you in the next one,